through some of the information returns as well. So let's first start off with PFIC, why there's PFIC rules, and what started this whole thing. So at one time, U.S. investors were able to kind of go offshore and invest in mutual funds, and they weren't forced to kind of recognize dividends from any kind of dividends that were paid out from the mutual funds. So what ended up happening there is that U.S. persons who invested in foreign mutual funds wound up having a unfair advantage to U.S. persons who invested into U.S. mutual funds. So that kind of left a situation where the U.S. mutual funds kind of got upset about it. They lobbied Congress for changes. This is back in the 1980s. I believe it was 83 or 84. And what happened is Congress perceived this to be a big problem because you had an unfair advantage over foreign mutual funds. And what Congress usually does when they see a tax issue that they perceive unfair, they'll go ahead and basically try killing a cockroach with a sledgehammer, so to speak. It's a total overreaction, but regardless, I mean, that's the basis for the PFIC rules, and we'll kind of we'll dive deeper into it in a minute. So the PFIC rules, they apply to foreign corporate stocks, all right? And when we think of PFIC itself, we typically think of PFIC basically impacting, say, a mutual fund, but it impacts a heck of a lot more than that. It can impact a foreign corporate stock that's not even in a mutual fund. And the other thing to keep in mind about these PFIC rules is that outside the United States, when you're dealing with, say, retirement plans, or you're dealing with even bank accounts, everybody outside the United States, their investment accounts holds on to foreign stocks, whether it's mutual funds or not. So anytime you're dealing with a U.S. person investing outside the United States, any type of financial account, you have to be on the lookout for whether it's going to be a PFIC, or if you have a foreign person coming into the United States, and let's just say they're either immigrating to the United States or they're working temporarily in the United States and they become a U.S. person, you have to watch out for these PFIC rules. All right. So what is a PFIC? What's the definition of a PFIC? So a corporate stock can be a PFIC if the stock satisfies either the so-called income or asset test. All right. So let's first start off with the income test. All right. Under the income test, a foreign corporation is a PFIC if 75% or more of the corporation's income for the taxable year is defined as foreign personal holding company for purposes of the Subpart F provisions of the Internal Revenue Code. There's some slight adjustments made as well. But so what is foreign personal holding company rules? They're defined in Internal Revenue Code section 9954C, which basically includes most passive income. Passive income such as interest income, dividends, rents, annuities, royalties, or gains in the sale of stocks, securities, or basic any kind of property that produces interest, dividends, rents, or so forth. So that's going to be your definition of personal holding company. All right. There are some adjustments made, as I just said, and basically these adjustments include for income that's derived from the active conduct of banking, insurance, securities. So if you have income from those sources that is non-passive, and if it's received from a related party, it's not going to be classified as personal holding company income. All right. A related person is defined in section 954D3, and basically a related person is any individual, corporation, partnership, trust, or estate that controls or is controlled by a foreign corporation, which should I say controlled foreign corporation. All right, so for purposes of the income test, so under the income test, a stock could be a PFIC if 50% of, it could be a PFIC if the average market value of the corporation's passive assets during a taxable year is 50% or more of its total assets. So an asset is characterized as passive if it has generated passive income or is reasonably expected to generate passive income in the hands of the foreign corporation. Assets that generate both passive and non-passive income in a tax year is treated as partly passive and partly non-passive in proportion to the relative amounts between the two incomes that are generated. So basically, if you have a foreign corporation and more than 50% of its total assets are producing passive income, then you could wind up having a situation where it's a PFIC. This has some pretty sweeping rules to it if you think about how this impacts the U.S. investor. Let's just say, for example, someone invests into a corporate stock that they believe is not passive. Let's just say it's a stock in a company like, say, Toyota, and let's just say, although Toyota is an active company that's making vehicles, let's just say Toyota hoards cash, and let's just say Toyota goes ahead and has a number of passive investments, which is quite common in some of these corporations that are outside the United States. So under this 50% passive rule, you could wind up characterizing stocks as PFICs in shares that we would ordinarily not believe to be PFICs. So always be on the lookout for that when you're determining whether something is a PFIC or not. Okay. So when we're dealing with PFICs, there are look-through rules. Okay, so for purposes of the PFIC income and asset test rules that we discussed, there's a look-through rules that apply to foreign corporations that own directly or indirectly at least 25% of the value of the stock in another corporation. Under this rule, a foreign corporation is treated as owning its proportional share of the other corporation's assets as it received it directly, its proportional share of the other corporation's income in determining whether the corporation is a PFIC. There are also special rules for startup or corporations, corporations startup year or corporations that are changing business. If you think about it, if you have a foreign corporation in its initial year, you have maybe say a lot of VC investment coming in, so it's pretty easy to have a startup classified as a PFIC. So under these rules, a foreign corporation is not treated as a PFIC during the first year it has gross income, also known as a startup year, as long as three requirements are satisfied. First, no predecessor of the corporation was a PFIC. Second, the corporation establishes to the satisfaction of the IRS that it's not a PFIC in either the first or second year of its startup. Third, the corporation is in fact not a PFIC for either the first 2 years, as I indicated. So, like I said, there are some changes. There are some rules that come into play for the startup year of a foreign corporation that might save it from being classified as a PFIC. A foreign corporation that is changing a business is not treated as a PFIC for the year if three requirements are satisfied. First, neither the corporation or nor any predecessor was a PFIC. Second, the corporation establishes the satisfaction of the IRS that substantially all of its passive income for the tax years attributable to proceeds from the disposition of one or more active trades or businesses, and it will not be a PFIC if either of the first 2 years of such tax years it was not did not passive income that satisfies the income or the asset or passive income test. All right. So once you for purposes of determining a PFIC, let me back up there. It's determined on an annual basis. All right. So a corporation could be a PFIC for 1 year and not be a PFIC for another year. All right. However, under Internal Revenue Code Section 1298B1, a foreign corporation status as a PFIC for even 1 year will taint that shareholder's status going forward, even if the corporation does not satisfy the PFIC test for other years. So during a year, it is a PFIC that you will wind up having specific tax consequences that we'll discuss in a minute. And in order to kind of purge the so-called PFIC stain, there are provisions in the Internal Revenue Code that can be done, which we'll discuss in a minute as well, which could kind of basically resolve that. Say if you had a isolated year or two of PFIC taint, so to speak. All right. Now, before we get to how PFIC itself is calculated, there is an overlap that should be understood. There's an overlap between the classification of a foreign corporation being a controlled foreign corporation or a CFC or a PFIC. It is possible that a foreign stock could be classified both as a CFC and a PFIC. But under Code Section 1297E1, if the corporation itself is classified as both a CFC and a PFIC, and when I say, and I know this is discussed in the last seminar, but just purposes of going through the rules again, a CFC is a foreign corporation is a CFC if you have more than 50% ownership by stock, of value, or vote of U.S. shareholders in the foreign corporation, then it will be classified as a CFC. PFIC itself, you don't have any defined ownership for purposes of triggering the PFIC rules. You can have one share in a corporation and own less than 1% in a foreign corporation, and the stock itself could still be classified as a PFIC. But when you have a situation that you have an overlap where, let's just say, the foreign corporation itself is treated as both a CFC and a PFIC, under 1297E1, if it's a CFC for that particular shareholder that has to calculate their tax consequences, then it will not be classified as a PFIC for purposes of the Internal Revenue Code. So let's just say you have shares in foreign corporation XYZ, and you have to recognize GILTI income or Subpart F income. You're not also going to have to recognize PFIC as well. I guess that's some good news. However, if you have a foreign corporation and it's not classified as a CFC for purposes of that individual shareholder, then it's going to be classified as a PFIC, and it has to be treated as such when you're determining your tax consequences. Okay, now let's dive into how PFICs are taxed. All right, so there are 3 tax regimes for purposes of PFIC. We'll start with Section 1291. That's basically the fallback approach. All right, so a shareholder of a PFIC is subject to Section 1291 and the so-called excess distribution rules in which a shareholder must allocate excess distributions and gains realized upon the sale of their PFIC shares pro rata to their holding period. So if we step back a minute, the standard PFIC rules, the way it works is you can have a share of a foreign corporation that's taxed as a PFIC. If the stock itself is not making an excess distribution, while you're holding on to the stock itself, you're not going to recognize any kind of tax consequences. What's going to wind up happening is you're going to recognize tax consequences when there's either an excess distribution or if there's a sale of the PFIC stock. That's when you're going to recognize the tax consequences of your PFIC shares. And these rules under Section 1291, these are called the so-called anti-deferral rules, and they're meant to basically punish taxpayers who are holding on to shares of PFIC, and let's just say they're not paying taxes on, or the stock is growing, and there's no U.S. taxes on that stock. So these rules were enacted to kind of have a punitive approach for how it's taxed. All right, so let's first discuss what is an excess distribution for purposes of 1291. All right, so an excess distribution includes the following: any gain realized on the sale of a PFIC stock, like I just mentioned. So if you sell your PFIC stock and it's taxed under 1291, you're going to be subject to the PFIC taxing rules. All right. Two, if there's an actual distribution made by the PFIC, but only to the extent that the total actual distribution received by the taxpayer for the year exceeds 125% of the average actual distribution received by the taxpayer in the preceding 3 years. The amount of excess distribution is treated as if it has been realized pro rata over the holding period of the foreign share, and therefore the tax due on the excess distribution is the sum of the deferred yearly tax amounts. This is computed by using the highest tax rate in effect in the years the income is accumulated, plus interest, and any actual distributions that fall below the 125% threshold are treated as dividends. And this assumes this represents a distribution of earnings and profits, which are taxable in the year of receipt and not subject to the special interest rules. All right. For purposes of saving time, I'm not going to go through. I have two examples that I have in the slides over here, which kind of go over how the 1291 rules tax an individual who is disposed of PFIC shares or who has dividends from PFIC shares. So the first one's a fairly easier example, and the second one's more complicated. But it kind of goes through basically how 1291 goes ahead and taxes somebody who winds up having a PFIC and it's taxed under the fallback provisions. All right. So when I started the presentation, I mentioned that we have a lot of people coming to the United States, and for a number of different reasons. But one of the common reasons is that you have people coming to the U.S. for work purposes, right? And the people coming to the U.S. for work purposes, they often don't do proper planning for U.S. tax purposes, and they maintain their bank accounts or their investments in their home country when they come to the U.S. So when they come to the U.S., they become a U.S. person either under the substantial presence test or they get a green card. They're treated as a U.S. person. So what happens to those individuals who are in the U.S. for a temporary period of time and they have PFIC, and let's just say they don't sell their PFIC and they go back to their home country? Some people that I've spoken to at least believe they could avoid the PFIC taxing regime by not liquidating these shares until they terminate their U.S. residency. So how do we determine if that's a feasible option? Okay, so the Internal Revenue Code characterizes a sale or exchange of a PFIC stock as a disposition. All right, a disposition is generally triggered when you have any kind of transfer of a PFIC stock, and that's under Code Section 1291F. So if you dive a little deeper into the proposed regulations, it kind of discusses a little bit more in detail about what a disposition is. And what the proposed regulations say is that for purposes of a disposition, when a person leaves the United States and they have PFIC shares, that's classified as a disposition for purposes of triggering a tax consequence. The proposed regulations do not discuss the term expatriation or covered expatriates as well. So if you have a person in the United States for a short period of time for work purposes, let's just say and they satisfy the substantial presence test or they satisfy the green card test, and they have PFIC shares, their cession of being a lawful permanent residency, having lawful permanent residency or leaving the United States could wind up being a disposition for purposes of the PFIC rules. So you could wind up having a tax consequence when they actually leave the United States, even if there is not an expatriation taking place. So something to keep in mind. All right. When I started the presentation, I said that there are 3 ways that a PFIC could be taxed. We've discussed already the 1291 rules, right? The fallback rules. Well, there's another way of taxing a PFIC, and that's under the qualified electing fund election. All right. So under the qualified fund election rules, a shareholder of a PFIC could opt out of the PFIC taxing regime. So in order to do so, you have to do it under the first year that you have the PFIC stocks, or the foreign stocks that are classified as PFICs, and this is discussed in Code Section 1293. But in order to be taxed under the qualified electing fund rules, the shareholder has to make an election to basically be treated as to be taxed under the qualified electing fund rules. A little later on, if we have time, when I'm going through the Form 8621, we'll discuss that part of the Form 8621, which talks about how you make that election to basically be treated under the qualified fund electing fund rules. But basically what it does, it allows an individual who makes this election to be taxed on their gross income on their pro rata shares of the fund's ordinary earnings for the year as ordinary income, and they're also allowed the pro rata share of the fund's net capital gains as long-term capital gains if applicable. So that's a pretty big difference, because remember, we're talking earlier about 1291. 1291 says there's no capital gains, there's no favorable capital gains taxes. You're taxed at the highest rate possible. It's taxed as ordinary income, whereas under the qualified fund electing rules, you basically can potentially get long-term capital gains rates, and you're paying ordinary earnings, but you're paying it on an annual basis. So with 1291, you could defer it, but you're going to have your interest charge. But under these rules over here, under the qualified funding electing rules, you basically have the ability to you pay it, but you could avoid your deferred interest. Now, interestingly enough, your qualified fund electing rules allows you to defer the tax as well. All right. So if you like, you can make an election on the Form 8621 to defer the tax consequences associated with making qualified fund election. However, when you do that, what's going to wind up happening is you're going to wind up having an interest charge. And we'll talk about how that interest charge works in a little bit as well. All right. So that is one. Now, the problem is that if you make a qualified fund electing rules, everything's great if you do it the first year, right? The problem is you have one of two situations. A, you might inherit the shares from somebody, right? Few people understand that when you inherit the shares of a PFIC from someone that may have passed away, you don't get a step-up basis. So you're basically inheriting a PFIC with a headache, or you may have not known that it was a PFIC. You may have not made a timely qualified fund election. So what you're going to have to do then is make an election to purge the taint of the PFIC. And what the purging of the taint of the PFIC is basically, you're going to basically under Code Section 1291 wind up having to recognize any deferred taxes or interest charges that is already so-called built into that that stock. All right, so something to keep in mind about when you're making when you're making an election for purposes of qualified funds or favorable qualified fund elections. All right, the final way a PFIC can be taxed is you can make what's called a mark-to-market election. The mark-to-market election basically allows you to avoid the PFIC taxing regime as well. In order to make the mark-to-market election, the stock has to be a so-called marketable stock, all right? So that's the first thing. So it's kind of hard to make the mark-to-market election. Let's just say you have an investment into a mutual fund, and what I've seen in the past, sometimes people don't even know what stocks are in it. So this is not always such an easy election to make. But anyway, under Code Section 1296, it discusses what a marketable stock is, and basically what it is that if it's on a traded market, either a recognized foreign trading market or it's recognized in the U.S. On a trading market, then you are allowed to make a mark-to-market election potentially. So what happens is that kind of like with the qualified fund election, you have to recognize your gains every single year on the increase in value of the share. So if the share goes up that year in value, even if you don't get the benefit of the share going up in value, you still have to recognize the increase in value of the share itself. It's discussed in detail under Code Section 1296 A and A2, and it kind of goes into detail into how that's done, and it also discusses a process known as unreversed inclusions, where that kind of winds up taking into consideration elections that you've done in the past for purposes of making determining your tax consequences going forward. Okay. All right. Let's talk about rules for determining attribution of stock ownership. So a U.S. person is treated as owning a portion of a share of a stock of a PFIC owned by any partnership, trust, or estate in which the U.S. person is a trust or beneficiary. In addition, if a U.S. person owns 50% or more in the value of a foreign corporation stock, the U.S. person is deemed to own the proportion share of stocks of a PFIC owned by the foreign corporation. Now, in 2022, the IRS issued proposed regulations, PFIC regulations, in the context of partnerships. So basically, if a partnership controls a foreign corporation, what will happen in that case is that the individual partners of the partnership can no longer go ahead and make their own individual election for purposes of determining the tax consequences of a PFIC. It's done by basically the partnership itself, or the partner who controls the controlling domestic partner. So if you are holding interest in a foreign corporation that is a PFIC through a partnership, make sure that the proper election itself is made, because that election itself will bind all U.S. persons in the partnership. So whether elections can be made for qualified fund, electing fund, market to market, or just your standard PFIC rules, that's determined on the partnership level, on how the distributions of the PFICs itself is going to be taxed. All right. Now, since we've kind of gone over how the PFIC rules generally operate, we're going to discuss how these are reported on your information returns. The slide over there has Form 8621, but before we go to Form 8621, there are two additional forms that anybody who's preparing a tax return or advising somebody of PFIC should also consider. If someone has a PFIC, the first thing you need to consider is whether or not the PFIC itself should be reported on FinCEN 114, the FBAR. Basically, United States Code Section 6314A basically states that a U.S. person has financial interest or signature authority in a financial account located in a foreign country. The aggregate value of over $10,000 anytime during a calendar year has to go ahead and report the interest on an FBAR. What is a financial account, right? A financial account includes securities, brokerage accounts, mutual funds, similar pooled funds. So under this broad definition of a financial account, that will probably go ahead and bring in a PFIC. So if you have somebody that has a mutual fund or a bank account that has foreign shares in it, it's probably going to wind up having to be reported on an FBAR if its aggregate value, or the individual's total aggregate value of foreign financial accounts exceeds $10,000 in that particular year. Also, Form 8938. If you have a PFIC, it will probably wind up also having to be reported on a Form 8938. Right. What is Form 8938? Real quick, individuals that have specified foreign financial assets during a tax year that are greater than $50,000, or the amount stated by the Internal Revenue Service, has to go ahead and report that onto the asset onto a 8938. So foreign assets, all foreign financial assets, which includes stocks or financial instruments, need to be reported on a Form 8938. So if you have a PFIC or PFIC account, and your total value of your foreign assets in a particular year exceeds $50,000, it's going to have to be reported onto a Form 8938 as well. Okay, so let's now dive into the Form 8621. All right. Oh, and with these other two forms, the 8938, it's important to know, if you don't report the PFIC on a Form 8938, you could be subjecting your client to a $10,000 penalty, or up to $50,000 penalty if the IRS makes a demand and there's no compliance with the demand. Furthermore, the statute of limitations does not begin to run for purposes of the IRS making an assessment until that Form 8938 is filed with the IRS. So your clock doesn't begin to tick on IRS audits or assessments until the Form 8938 is filed. What I'm not sure about, if the $10,000 penalty is an automatic penalty. The IRS has been doing a bunch of automatic penalties lately. I'm not sure if this is one of them. In regards to the FBAR, if you don't report the foreign financial asset, which is the F bar, I mean the PFIC on the F bar, and you should have, your minimum penalty starts at $10,000 and can go up to $100,000 or 50% of the value of the account if it's determined to be willful. The difference with the not filing the F bar, that does not toll the statute of limitations as the 8938 does. So if you don't file, you don't report the PFIC on the F bar, that's not going to toll your statute of limitations. Instead, the statute of limitations on that for civil purposes is 6 years, and if there's an issue of criminal, it's only 5. All right. Now let's talk about the Form 8621. So the Form 8621 itself, there are no penalties for not filing the Form 8621. But what does wind up happening with, if you don't file it, is that the statute of limitations does not begin to run until it's filed. All right, I see that we're running low on time, so I'm going to run through this real quick. All right, and what parts of this form itself that you need to be concerned about. All right, if you are making your basic information regarding a PFIC goes on to Part 1 of the Form 8621. However, if you're making a mark-to-market election, it does not wind up on Part 1 of the form. All right, it's fairly basic questions. It just asks questions about, you know, holding on to shares and what type of shares that you wind up holding on to. Part 2, if you have the excess distribution. All right, if you have excess distribution on from a PFIC or elections for PFIC purposes. So let's just say you have your standard excess distribution, you have your mark-to-market election, or if you have your qualified fund election, you're going to go ahead and check the appropriate boxes. It's also important to check the appropriate box if you are making a liquidation of a share to purge PFIC taint. And there's a difference. I believe there's a difference in the boxes. Let me take a quick look here. Sorry. So if you check box D and E, if you're doing a deemed sale election for PFIC purposes, for qualified fund election, one is going to be for your dividend, the other is going to be for the sale of the stock. You're going to be checking boxes F, G, or H if you wind up inheriting a PFIC from somebody, and you're trying to go ahead and purge the PFIC taint. So the other important things to take away from all this is, well, you should also look at another important section would be under Section 5. And under Section 5, line 16F, it's a very important part of the form itself, because that discusses your interest rate and how the interest rate is calculated for purposes of your PFIC under 1291, or if you make an election to defer your recognition of income under the qualified fund election rules. And if you have one of these cases, or you're doing computation, it's going to be discussed in Internal Revenue Code section 6621, and Code section 6621A states that basically, for purposes of your throwback interest, it's your federal short-term rate plus 3 basis points for determining your interest on your calculation for your individual PFIC shareholder. Yeah, I guess we're running out of time. So if anybody has any questions, please feel free to give me a call, send me an email. I'd love to take any questions that you may have online. Thank you very much.
Thank you to our speakers for their insight so far. It's a reminder